traders and investors, we are looking at factors, economic factors that affect trading, that's move prices in the economy. The market moved by people that's making decisions, and those decisions affect price movement. But also, there is what we call fundamental analysis. There's economic factors that affect the price in the market. So we're looking at that. One of those economic factors is the unemployment rate. So the question you and I, as investors, need to ask is, what is the unemployment rate and how important it is for prices in the market. So one of them is the unemployment rate. What is the unemployment rate? So basically, the unemployment rate is the number of people in the labor market that doesn't have a job at the moment but is actively looking for a job. So if you unemployed, if you don't have a job, you are not looking, you're not counted on the unemployment rate. When we said today the employment rate is about 3.6, but if you look at how many people is not even looking for a job, the unemployment rate is way high. So we need to know that as investors and traders. So why is unemployment rate is important to us? Here's the reason. It is generally viewed as a lagging indicator. A lagging indicator is a secondary indicator. That means it doesn't have a direct effect on the economy. It doesn't have the direct effect on what the health of the economy. But we need to understand that generally it's viewed as a lagging indicator. If it was a leading indicator, that means it's directly affect the health of the economy. Even though it's not a leading indicator, it is important because when usually when traders hear that we have a lot of the unemployment is increasing, what is the tendency? They have the tendency to sell. Okay, they say trouble is coming. If people are not finding job, is a lot of companies are laying people off. We have unemployment increasing. That's mean if you are a stockbroker, if you're a stock investor, if you are a trader, you need to pay attention to that because you might be in a position and then this number will come out that might make you get a loss in the economy. We don't want that. The number of unemployed people is an important signal of the overall health of the economy. Okay, we need to understand this. This is an important signal that give us an overall economic health. If people are not finding job, if the unemployment wages continue to increase, that means more people doesn't have a job. They will need insurance. They will need unemployment to live. That is a problem for the economy. Okay, so the people will not be able to buy as much as they want. They not be able to buy what they want to buy. So that's important for us to know that the number of unemployed people is an important overall economic health for us to understand that. We need to know that as investors. Consumer spending is highly correlated with the labor market conditions. So if you have more people unemployed, that means they don't have income coming in. If they don't have income, they don't have buying power. If they don't have buying power, they can't buy stuff. If they can buy stuff, that means the companies can hire more people, right? Can hire more people because we don't have a lot of people buying in the market. So that's mean the people who's looking for a job gonna be they won't be able to find a job. That's a big problem. That's why we call the labor market. The labor market is how many people is available with the skill to find a job, to get a job. That's important. So you and I, we need to understand that unemployment is also a major consideration for those directing the country's monetary policy. So, as investors, if we don't know that the central bank in any country, or the are important because the monetary policy, they set interest rate, they do all that. Why? Because they want to stimulate the economy. They want to help lower the interest rate so companies can have borrow money so they can grow. When they borrow money, they can grow. More people get jobs, and then as they get paid, they get income, and then those people come back and start buying. They have buying power. They start spending in the economy, make the economy to grow. So when you produce more, you can pay people more, and people can buy more. That's mean the economy is growing. The unemployment rate is the measure of the share of the number of people in the economy that doesn't have a job but actively is looking for one.